Vice President Paras, conveners, my other colleagues and friends. Good morning and welcome to you to this workshop on taxation of foreign remittance. First, due to globalization of businesses and liberalization of foreign exchange policies, there are frequent demands for the remittances from clients. The government of India wants their due share of taxes on the remittances. The onus of determining taxes is casted on us professionals. TDS or withholding of taxes on remittances sounds very simple, but it is quite complicated and intermingling. For determining taxation for every remittances, one need to look at various aspects of the taxation laws, such as whether the remittance is income. If it is so, whether the income accrues or arises in India. If so, further, whether such income is taxable in India. Because some of the income, though accrue or arise in India, but may not be taxable in India, but due to the treaty provisions, it may be taxable in other countries. For example, capital gains between India and Singapore, if the person is resident of Singapore, then it is taxable in Singapore and not in India. So, the further question comes up is a resident of which country? And if it is residents of country, the provisions of the TRC which is applicable, and also the format. Certain countries give the TRC in their format, so whether that is acceptable or not. Which treaty to apply, because sometimes more than one country is involved. The professional may be, the recipient may be resident of one country but is dealing to other country. So which treaty to apply? What is the nature of income? As per income tax provisions, it may be business income. But as per the treaty, it may be other income which may be like FTAs or a shipping business, which requires different treatment. And if it is a business income, how to attribute profits? Once all these are determined, then the question arises what tax is applicable. Tax rate as per the rate in force or rate as per treaty. And suddenly one realizes that PAN is not there, so whether section 206AA is applicable. I think the questions are innumerous. To answer all this and many more questions which arises in day-to-day practice, the committee has arranged this workshop. The Chairman Paresh will explain the structure of the workshop in detail. And before I hand over the proceedings to the Chairman, as per the statistics of the participants given to me, almost 40% of the participants are non-members. For their benefit, I will take this opportunity to introduce you to the Chamber and make you known about the activities of the Chamber. Established in the year 1926, the Chamber is not-for-profit organization which its mandate to disseminate knowledge in the field of taxation, corporate and allied laws, accounting and finance. The Chamber caters to the needs of professionals both in practice as well as industry. It has a robust membership of more than 3,500 professionals comprising of chartered accountants, company secretary, tax professionals and advocates. Chamber operates through various committees, each catering to a specific area. The committee organizes programs on various topics such as direct taxes, indirect taxes, corporate laws, international taxation and allied laws. Knowledge sharing and dissemination is carried out through various conferences, seminars, study circles and study groups, residential refresher courses and publications. Chamber also publishes a monthly journal called the Chamber's Journal. The journal is well appreciated by the readers and it finds place in the libraries across India. Chamber manages two libraries at prominent places like Aikar Bhavan and Pratyaksha Kar Bhavan, which are widely used by the professionals and students. These libraries have more than 4,000 titles and all leading law journals and magazines. The Chamber is also active in making representation to Ministry of Finance and Tax Department. In recent years, the Chamber has acted as a catalyst and has contributed substantially to the development of better tax laws, administrations and compliances. With this brief remark, I would now request Chairman to take the proceedings further. Thank you.
Learned Speaker Sri Vispi Patel, my President Yatin Desai, Rajesh, past presidents, ladies and gentlemen. Good morning to all of you and warm welcome. I'm really overwhelmed by the large participation in terms of your presence on Friday morning. I'm really delighted that we have record number of participants for the course which we have uniquely designed for the first time at Chimbar, and also very different from a conventional courses which is being designed by other organizations also. Friends, that brings me to the structure of this program. It is styled as taxation of foreign remittances, unlike taxation of foreign income, unlike taxation of non-resident, unlike provisions of double tax avoidance agreements. Why? Section 195 of the Act is applicable to a sum chargeable to tax, irrespective whether the sum is partially chargeable to tax or wholly chargeable to tax. Therefore, a taxation of remittance, so far as Section 195 is concerned, is very important. Coming to the various sessions of the program, as I mentioned, it's unlike DTAA course, unlike taxation of non-residents. What we want to say that in double taxation and in treaty-related taxation, it incorporates and deals with the taxation of residents as well as non-residents. When it comes to treaty, two countries are involved. Either of the country could be a source country and other country could be a resident country. Today we are only concerned with the taxation of some chargeable to tax which are foreign remittances. So we are largely concerned with the taxation of non-residents, not necessarily non-resident, which I come a little later to explain. Then, looking at the scope of foreign remittances, you will note that we have not incorporated a very important article on tax credit in the structure of the program, because largely the tax credit provisions are employed by the residents of a country who are recipient of the payments from India, who are not resident of India, but they are non-resident, and they are largely processed involved in the country of residence of a non-resident. And therefore, we have not covered any aspects of tax credit. However, we requested Dustbin Bhai to deal with the issue as it is applicable to the payer of the income to the non-resident, because if the tax is not deducted in accordance with the convention, there will be difficulty of tax credit in the country of residence for the non-resident. To that extent, the tax credit article is important, which will be dealt by Dustbin Bhai. Then you will not find the Article 9 in the discussion, because largely concerning the transferring provision in India and the suitable adjustment in the country of non-residence residence status. And therefore, we have not touched upon Article 9 for the discussion purposes. Then you will not find any discussion on immovable properties. Why? Because there are hardly any differences in the provision of taxation of non-resident and resident under the caption income from house properties and income from other sources, so far as rental income of such house properties are concerned. Not only that, there are hardly any tax issues so far as non-resident is concerned, and there are hardly a difference between the treatment of resident and non-resident. Therefore, we not considered Article 6 for the purpose of discussion. Thereafter, slightly non-discrimination is concerned. There the TDS provisions are affected, and therefore non-discrimination article also will be touched upon to that extent by Dustbin Bhai. And thereafter we have Article 25 to 31, which are administrative section. We are not covering those aspects also because they are not so relevant. They are more like an academic. With this, that is the scope of the workshop, and it is not therefore a double tax avoidance course. It is taxation of foreign remittances. So far as section 195 is concerned, you are also concerned with what is the scope of sum chargeable to tax and what is the tax rate which may be applicable. Tax rates as available in the provisions of the law like 115 CA and other sections where tax rates are provided. Then tax rates in force which are provided in the Finance Act. Then we come to tax rates which are provided under 206AA, section 206AA, and then may be grossed up under section 195A if the payment is net of taxes. And then we come to treaty tax rates. Whatever beneficial to you as per the law will be applied. So there are number of tax rates which are to be dealt with when you employ section 195 to your advantage. And therefore, it is very important that how tax rates can be picked up from the treaty provisions. It is not plain simple. At committee of the chamber, when we were discussing, it was deliberated that number of practitioners were not exposed to the treaty related issues in their offices have come up with the question that which treaty to apply, what rate to be applied, because at time, because of the presence of MFN clause, the other treaties beneficial provisions applies. For example, India-France treaty, India-German treaty. Because of the MFN clause in India-France treaty, the beneficial provision of German treaty will apply because of the protocol in the India-France treaty. Such exposure is very essential in order to appropriately employ section 195 to your advantage. And therefore, we have a session on how to read tax treaty to your advantage while employing section 195 so that a correct tax rate and correct scope of income is made applicable as compared to the domestic tax law. And therefore, we have Rashmin Bhai to deal with a very important session today afternoon to understand how the treaty mechanism apply, how the tax credit mechanism in the tax resident countries apply, etc. With this, I come to the structure today that we have Mr. Vispi Patel to start with on overview of non-resident taxation, which will give you the flavor of what is largely and on overall basis applicable under section 195. Thereafter, we come to the law and procedure of TDS provisions under section 195 applicable to non-residents, followed by how to read tax treaty and the tax treaty related issues so that we comprehensively understand the law and procedure applicable in India as well as treaty related issues so that if beneficial provisions are available in the treaty, we are able to employ to our advantage and to the appropriately for the advantage of tax gatherers as well as taxpayers. And thereafter, we have the subject wise, the income characterization wise discussion on how it is taxed in India, how it will be taxed under the treaty, one by one, interest, dividend, business income, royalties and FTS, independent professional services. And so far as remuneration is concerned, you will notice we are covering inbound as well as outbound deputation. Why? Because both inbound employee as well as outbound employees could be non-resident, and therefore both should be covered so far as the scope is concerned. Therefore, we have covered both the sides of employment for the purpose of our deliberations. And then we come to the last session on the brain trust. We have two brain trustees to deal with almost all those questions which may arise during the deliberation in 3.5 day course workshop. And this will be sort of a revision what we have learned in all 13-14 session at the end of the course. With this, friends, I come to the pleasant task of introducing our learned speaker, Vispi Patel. he told me that please don't introduce me. But by opening remark of my president, he says that 40% of the participants are new. So for their benefit, I would like to introduce Vispi. He is a founder of a chartered accountant firm, Vispi Patel and Associates, one of the leading firm in India in tax and international taxation practice, as named by International Tax Review magazine. The firm is also one of the leading best newcomer in Asia, again adjudged by the International Review magazine. And the firm is also named as one of the, not firm, Mr. Vispi Patel himself has been named as one of the India's leading tax and tax pricing expert, again adjudged by the World Tax and the Euromoney Media and Legal Group of International Tax Review. Friends, with this, I may further add that he is an author of various articles in the international magazine like Tax Analyst, International Tax Review, not because he is expert. He always tells me, Paresh, don't read the law that you know it. Always read the law again and again, you will find out something new. He always comes up with some googlies, and which is what makes him being invited to various world magazines, popular magazines, to write on their behalf. He is also contributing to the various journals and the newspapers in India and outside India. He has spoken at various conferences in India as well as outside India. And before he founded his practice in Vispi Patel and Associates name, he has in his back experience of 30 years as a tax professional. And that experience includes working with various large accounting firms as well as the law firms. Friends, you will notice that we have 14th session, 11 speakers and 2 brain trustees. Like a cricket game, we have 11 players, 2 referees, and our opening batsman is Mr. Vispi Patel. Before I present him before you, I request my president to present him a memento as a mark of our love and affection. I forgot that he is a very dear friend of Chamber, be it at SDT course, a long duration TP course, or an international tax course, or an international tax conference. Vispi is omnipresent. Thank you very much, friends.
Okay, good morning friends on the dais, friends, youngsters and seniors in the conference. Good morning to everyone. And I trust that the most embarrassing moment is when my friends introduce me. I should always say I'm a brother professional, come here to share my knowledge if there is any. And we'll just take it up from there and try and see whether we can understand and unravel the mysteries of tax. Tax is no mystery, tax is a legislation. The more you read it, the more you will find that there are different facets, nuances to it. So what are we going to discuss today? I'm just going to give you an overview of non-resident taxation, and I think one of the most critical things, and that's what I've seen in my life, is that people forget that whether you're resident, non-resident, resident but not already resident, whether you're a corporate body, whether you're an AOP, whether you're a BOI, ultimately taxation comes from where? It comes from the Act, no? So therefore, to study the principles of taxation, you have to understand what is the scope of taxation for because we are dealing with remittances to non-residents, we should try and understand what is the scope of taxation as per the Act. After we have understood what is the liability under the Act, if at all there is any, then only you will travel to section 90. So there are sections 1 to 89 before 90. People tend to forget that, and therefore they jump to the treaty. So it's critical. It is important. It is essential that we understand the charge of tax, the scope of tax, and who is taxed and what is taxed before we even travel to the treaty. Because if you don't understand those principles, then you cannot apply the treaty. So it's like telling someone that what is the groundwork, what is the foundation? The foundation is the Income Tax Act. Is there any such thing as non-resident taxation? Is there any such thing as international taxation? I believe no. I believe it's all tax, income tax, emanating from section 4 of the Income Tax Act. So I'll now just take you quickly through the scheme of the Act. I think that's critical. So what is that section which gives teeth to the administration to charge tax is section 4. So if you take out section 4, we'll probably be doing some other profession. You take out section 4 from the Income Tax Act, and I think we all will be away from tax. For yesterday, I think there was some news item, no? That someone from some political party believes that he can abolish income tax and bring in income tax indirectly through expenditure tax. These are all fiscal measures to collect revenue. What is income tax? It's a tax on income so that you fill in the coffers of the treasury, so that the treasury can be looted by our parliamentarians. No politics, back to tax. Okay? So therefore that's the situation. So therefore section 4 is the most critical part of the Income Tax Act, which people tend to forget. So therefore I'm just trying to remind you of the basics, and if you are already aware of that, we'll try and brush the basics. So therefore it's the tax on income of the previous year at the rates in force as per the Finance Act. And who is covered? Everyone under the world is covered. All types of persons, including individuals, including artificial juridical persons, including association of persons, BOI, local authority, anyone. So this is the, unless you can find some person who doesn't fit into this definition, then probably you will escape taxation. So would aliens escape taxation? Probably. So now we come to that if section 4 tells us what is taxable, who is taxable, then when that person becomes taxable, then the scope is the critical part, because the scope will tell us, as far as we are concerned, what becomes taxable in the person's hand depending upon his residential status. So therefore, as this whole workshop has been designed by the chamber and by my friend Paresh and Yatin and everyone on the committee in the audience, the point is that we'll try and focus our attention to non-residents and how they are taxed. So therefore, I think this is critical. We will look upon non-residents and how they are taxed, and not non-resident taxation. So, because you find courses where they talk of DTAA, they will talk of non-resident taxation. The important thing is that there is a person who is classified his status as a non-resident under the Act, and therefore he becomes taxable according to the scope given by section 5. So therefore you have to find that meaning, that understanding that goes to the very heart of the problem, is that how do you tax non-residents? So you will tax non-residents, and their scope is defined by section 5, and that's critical. And what does section 5 say? The total income of any previous year of a person who is non-resident includes all income which is received or deemed to be received in India, accrues or arises or is deemed to accrue or arise to him in India. So therefore, the critical part is received, deemed to be received is simple. So if you receive something, if a non-resident receives income in India, irrespective of where it accrues, it becomes taxable in India. If it arises, if it accrues, it's simple. You come, you do business, you probably sell shares, so it will probably arise in India. But now, there is this deeming fiction of what is deemed to accrue or arise in India, and that suddenly expands the scope of taxation of non-residents. So therefore, we will try and study what is the meaning of this word deemed to accrue or arise in India, because it is critical, because it is linked to what becomes taxable in the hands of the non-resident, so that the charge of tax under section 4 can be levied on the non-resident. So that's the loop, and that loop is critical, friends. How much ever years you may practice law of income tax, the critical part is section 4 read with section 5 that defines scope, read with section 6 which defines residence, and therefore section 9, because section 9 is part and parcel of section 5, because it gives us the meaning of the words what is deemed to accrue or arise in India. So that's the way we tend to study taxation of non-residents. And why is taxation of non-residents critical? Because when you make payment to non-residents, whether that payment is an payment which has income embedded in it or income not embedded in it, will be determined by the act, not by the treaty. That's critical. The taxability of a payment made to a non-resident is first determined by the Income Tax Act. What does the treaty do? When we discuss the treaty, when we discuss double taxation avoidance agreements, I will just try and give you the flavor of them, that what does a treaty do vis-a-vis the Income Tax Act. But the liability, the initial liability is under section 4. That's critical. And who is a non-resident? A non-resident includes the person who is resident but not ordinary resident, who is not resident in India. Because as we all know, residents are charged on global income. So now let's try and understand. So this will give you a little flavor of what is the scope of taxation. So for a resident and ordinary resident, all incomes, whether they are accrued or arisen in India, received in India, accrued outside India, deemed to accrue in India, first receipt in India, all taxable, and even income accruing outside India and received outside India for a resident and ordinary resident. For a resident but not ordinary resident, foreign incomes are not taxable, except to the extent that if a business is set up in India, is controlled in India, or a profession is set up in India, then a resident but not ordinary resident will get taxable for the foreign income. While for a non-resident, what is taxable is only the income which is received in India, accrues or arises in India, or is deemed to accrue or arise in India. That's critical. Fine. Then we come to section 6 and the residential status, because the residential status determines the scope of taxation. So residential status is clear. You all must be aware of it, that if you spend more than 182 days in India, or you're at least 365 days in the last 4 years in India and 60 days in that previous year, then you become a resident. The exception being that if you are an Indian who goes abroad for the purposes of employment or employment on a crew of a ship, then 60 days becomes 182 days. If you don't satisfy both the conditions, then you become a non-resident. Then there is this in-between status between a resident and a non-resident only for individuals and for an HUF, and the HUF gets its resident status from its karta. is that you would be not ordinary resident and your foreign income would not be taxable. Especially this is important because India exports a lot of labor. So when they come back to India, to what extent is their foreign income taxable and to what extent relief is available is given by the status of not ordinary resident, which says that if you don't fulfill either of the two, you will be not ordinary resident. You should be non-resident in 9 out of the 10 previous years, or you should have been not present in India you should be present in India for less than 729 days in the previous 7 years. An HUF firm or a company is said to be a resident in India if during the previous year the control and management of its affairs is situated, the word most important is wholly in India, not mainly, it's wholly. So if you go back to jurisprudence, if you understand the law, you will understand that wholly means fully. So now we come to understanding of section 9 and its corresponding effect on the treaty. So let's try and understand this. That non-residents, when they have some nexus with India, whether it be an income nexus, whether it be a territorial nexus, for the purposes of earning income from the country of India, then section 9 comes into play. So section 9 is the section which is mentioned in section 5 because section 9 defines what is deemed to accrue or arise in India. So this is critical, this is extremely important, that section 9 gives meaning to the word what is deemed to accrue or arise in India, and it expands the scope of taxation, especially in today's world. All countries are facing this grave problem that source countries tend to lose revenue due to the great advancement of information technology, and with the speed with which data is becoming digitized and with the speed with which transactions take place on the internet, there is a great feeling of loss among source countries that when payments are being made on the internet, how do you catch that particular payment and make it taxable in the source country? And probably as time will evolve, principles of taxation may need to be changed, because up till now there is a fight going on in the minds of people whether the original principles of taxation as devised by the Income Tax Act of each country, is it strong enough, is its scope large enough to catch these payments which rightfully should be taxed in the source country because of its nexus with that particular source country. So these are situations which can be probably taken up in another seminar, is to try and understand how e-commerce, how digitization of data, and what is its effect on taxation and what is its effect in eroding the base of taxation of source countries. I mean, it's a bigger thing where OECD and all countries are trying to pay attention to it and find some methodology which is neutral, which does not affect commerce or trade, but at the same time does not deprive the rightful revenue of the countries. So therefore, section 9 tends to expand the scope of taxation of non-residents, and therefore we will try and touch upon the basic principles, because those principles, when enunciated in this first session, will help you to understand when they are taken up in detail by the various speakers as the course has been structured. But to understand in depth that particular subject when it is taken up, it is necessary to understand its first principles. If you don't understand first principles, friends, then the foundation of the building is weak. So therefore, section 9 deals with, first 9.1 deals with business income and probably capital gains to some extent, then salary income, dividend, interest, royalties and fees for technical services. Corresponding articles, which are as per the OECD Model Convention and to a great extent the UN Model Convention, India follows a mix of both depending upon the treaty partner who is negotiating, because you have to understand that a DTAA or a treaty is based on the economic strength of each nation. So probably what India negotiated 50 years back and what it negotiates today, there is a vast difference. Today, when you negotiate from a position of strength. When we negotiated 50 years back, when we were just emerging from independence, we negotiated not from a position of strength, but from a position of weakness. And therefore, resident countries could enforce certain principles of double taxation which were in their favor and not in the favor of the country of source. So therefore, that's an evolution of economics. So therefore, you find that business article under the treaty is covered by Article 5, which determines what is a permanent establishment or what is loosely termed as a business connection. And its taxation is determined by Article 7. So Article 7 gives the scope of permanent establishment taxation, while Article 5 determines whether a permanent establishment or a place of business of the non-resident is there in the source country or not. So it's important. Article 5 and Article 9 therefore correspond to each other. Then there is salary income, like that you have dependent personal services article, Article 15, dividend income, Article 10, interest income, Article 11, Article 12 is royalties, and fees for technical services, Article 12, and capital gains is Article 13. So these are, I'm just trying to give you a flavor that when you see Section 9, how do you correspond it to the various articles when you read the treaty, and what is the force of a treaty and what is the force of legislation. They act in different spheres. So we'll try and understand what is the scope of a treaty and what is the scope of taxation. That I have already told you, that the scope of taxation is to garner revenue for the government to fulfill its objectives for which the parliament is formed. I hope that they believe that. As of today, we don't believe that they understand what a parliament is supposed to do. So now let's try and understand Section 9. As in Section 9(1)(1) is the most critical section. It's the most important section because it tends to bring within its scope not only business income but also capital gains. So what does 9(1)(1) say? That all income, directly or indirectly, through or from any business connection or property or asset or source of income in India, or through transfer of a capital asset situated in India, becomes taxable in India in the hands of the non-resident. As you must be well aware, and I will just touch upon it for a very short time, that there was a great tussle between the, why do you call litigation tussle? Let's say that there was a great, there was a process whereby the correct discovery or the interpretation of law took place, that what is the scope of Section 9(1)(1), and therefore you had that Vodafone case which went on for 2 years, and what were the principles that emanated, and what was the defensive posture of the government to try and retrospectively amend Section 9(1) to probably bring the law away from the interpretation of 9(1)(1) as interpreted by the Supreme Court in the Vodafone case. Okay, so therefore the most important part of 9(1)(1) is the business connection, and this business connection can be considered to be a test of activity of the non-resident in India. So it's a business activity test. So if you have an activity in India which tantamounts to a business connection, then income emanating from that business connection in the hands of the non-resident would become taxable in India, irrespective of the fact that the income may be received abroad, payment may be made abroad, but because of the activity, it becomes taxable in India as per the domestic law or the Indian Income Tax Act. So what's a business connection is never defined, only jurisprudence evolves the definition, and probably one of the most early cases, 56 ITRs, CIT versus R.D. Agarwal, gave certain basic principles of what is a business connection, and a business connection means that there has to be a real business nexus between the activity of the non-resident and the activity in India, whether that activity in India is carried out through a branch, through an agent, through an office. The business connection test is much wider than the permanent establishment test in Article 5. Article 5 tends to reduce the scope of the business connection test, while Article 9 is a very broad test. And therefore, when you come from non-treaty countries, then the test is extremely wide, and the principles are still wider, because everything gets submerged in this nexus of business activity with the earning of income which is deemed to accrue or arise in India because of the nexus of the business connection test. Then, as far as property or asset or source of income is concerned, it is only taxable if it is in India, and as I explained to you, the business connection and the P under the permanent establishment test under the treaty are slightly on different parameters. If you want, just figuratively, if business connection is the set, then permanent establishment is the subset of that set. So business connection test is wider, while the permanent establishment test is narrower. Because of the Vodafone case and the interpretation of the Vodafone case, that income would be deemed to accrue or arise in India if there was a transfer of a capital asset situated in India, only if there is a direct transfer, not if there is an indirect transfer. And the transfer has to be of the asset in India, so therefore that share or that property or that business interest has to be residing in India directly and not indirectly. So that was the interpretation. I mean, I'm not getting into Vodafone at this stage. But the important thing was that there was a restrictive meaning given to section 911, because one of the first principles of taxation is that you will read the law as it is. That's the first principle of income tax. You read the law as it is legislated. You will not add one word to it, you will not subtract one word from it. That's the original principle of taxation, which you will get best in the first 50 ITRs. Now, probably over a period of time, those principles tend to get diluted. But the original principles of taxation are, read the law as it is, without adding a word to it, without subtracting a word to it, without finding the intendment of the section also. If the intendment of the section fails, the charge fails. You cannot add words to a statute to bring the spirit of the legislation into force. You will only read the legislation because it's a taxing statute, so you will read it strictly. So it applies both to the revenue and to the assessee. So the test is both. So if you read the act strictly and the burden is burdensome, you cannot remove that burden. So as there was a smile on people's faces when I said that you have to read the act strictly, and when it is read strictly and the charge is tremendous, you cannot escape the charge. But if the charge fails, then the revenue cannot go and tax you on that income. So it's both ways. It cuts both ways. It's like a sharp-edged knife law. You walk on it, and you tread on it very carefully. So therefore, Vodafone interpreted section 911 on that basis. So what does the government come and do? So the Finance Act 2012 was one of the most critical phases of the evolution of the Indian Income Tax Act, because probably never in the history of the Indian Income Tax Act has there been so many retrospective amendments made in one Finance Act as compared to the plethora of amendments made over the period of time since Indian income tax has been introduced, right from 1922. So therefore, to bring in such indirect transfers of shares, because for example, if you have companies in Mauritius holding shares in India And because the shares in Mauritius get transferred, or a share in Cayman Island gets transferred, as it was in Vodafone's case, it doesn't get taxed in India, though it derives value from the assets in India. So therefore, to circumvent that, they went and amended this particular section 911 to say through capital assets situated in India, retrospectively means by means of, in consequence of, by reason of. So it's an indirect meaning. And the capital asset is deemed to be situated in India, whether it be share or interest in a company or entity registered outside India or incorporated outside India, if it derives directly or indirectly its value substantially from assets located in India. So you dispose of a share of a shell company outside India which derives value from an operating company in India, then will it get covered is the question of law. But remember, to safeguard this particular situation of the amendment to section 9(1), as I showed you in the earlier chart, you have to read article 13 of the capital gains article in the treaty and see whether such indirect transfers get covered in article 13 or not. But if you come from a non-treaty country, then your scope of taxation is tremendous, is very large. And this has been done retrospectively from 1462. That means right from the time when the 1961 Act came into force. And therefore, I'm just trying to give you a flavor that section 9 is the most critical part, and 911, its scope is only, it may be only of 6 lines, but look at its scope and how wide it is. And therefore, when you make payments to non-residents, to what extent care has to be exercised and the level of analysis that has to be done for the purposes of determining whether that payment has income embedded in it and whether you need to withhold taxes or you don't need to withhold taxes. And if you don't withhold taxes, what is the liability on you and what is the penalty on you and probably what is the prosecution on you. So now we come to salaries. 912 tells us that if the salary is earned in India, that means if services are rendered in India, that means they are supposed to be earned in India. This is a deeming fiction, irrespective of where the contract of employment is, where the payment is made. So if a foreigner comes to India, renders services in India, but receives payment abroad, contract of employment is abroad, it still becomes taxable under section 912. And therefore, the main effect of this clause is to obviate the necessity what happens where the charge is outside but there is a deemed accrual in India, it becomes taxable as per the domestic law. Now we come to one of the other most controversial parts of the Indian Income Tax Act. Not controversial, what I would call the very burdensome part of section 9 is to tax royalties and fees for technical services. So therefore, the principle that has become now enunciated in the Indian Income Tax Act with various retrospective amendments is that there is a deemed accrual or arising of income of royalty and technical services fees in India if the basic principle, if the payment is made from India by a resident or by a government or even by a non-resident, to the extent that such royalty or fees for technical services is used for making or earning any income from any source in India. So therefore, not only is a resident covered when he makes payment, even a non-resident is covered. And we'll come to that when we discuss section 195. Extremely burdensome. Two people doing business abroad, unknowingly you get caught because of section 9. Is it correct? Is it fair? Is that charge correct? That only law will decide. But I'll just try and touch upon that. So therefore, the principle of accrual is based on the principle of payment, unfortunately or fortunately. And the definition of royalty is extremely wide in the Income Tax Act as given by expansion 2 as compared to the definition of royalty under the treaty. So therefore, under the Indian Income Tax Act, royalty would cover all types of payments for transfer of know-how, patents, trademarks, use of that, imparting of any information, services connected with that, any information, and the transfer of all or any rights in any copyright, literally artistic or scientific work. So the scope is extremely wide. It gets restricted in the treaty, and that's what is essential that has to be evaluated. Then there has been an amendment, and these amendments that have been brought about by retrospective amendment is to try and increase the scope of taxation, and all of them have been brought about by way of clarification. Clarification means the legislature believes that this was always the intention, and we are only trying to clarify and explain to the reader of the law that this was what the law was always, irrespective of whether the jurisprudence interpreted the law differently. So therefore, there is a great controversy that when you use computer software for your own personal purpose, whether it be for office or personal use, is there any payment of royalty to be done on the single user license? There are plethora of cases on both sides, and under the Indian Income Tax Act, this becomes now taxable, and they believe that this is also within the definition of royalty. Explanation 5 has expanded the scope to say that irrespective of whether that particular know-how or that particular information is in, or that particular right is in the possession of the payer, is outside India, or is not used by the payer, it still becomes royalty. So therefore, to some extent, both explanation 5 and 6 tends to increase all sorts of new payments which are coming to being. That means payments for live feed, payments for transponders, payments for satellite usage charges, and therefore there has been a plethora of controversy on these issues. But under the Indian Income Tax Act, now the clarification is that all such payments would be roped within Section 9 as deemed to accrue or arise in India, and therefore it expands the scope on which payments non-residents are liable to pay tax in India under the Indian Income Tax Act. Similarly, for fees for technical services, though the articles and various treaties may restrict the scope of fees for technical services, under the Indian Income Tax Act, it is extremely broad and covers mostly all services, whether it be of a managerial, technical or consultancy in nature. But to give effect to and to encourage certain industries, if they are in lieu of construction, assembly, mining or any like project, then they are not taxable under Section 917. But don't forget that they may not be taxable under 917, but they will be taxable as business profits from a business connection under 911. It doesn't escape taxation because probably a business connection would be there unless there is no business connection. And there was a controversy on this particular aspect because of the Ishika Javima decision of the Supreme Court, which said that in case of technical services, it is not enough if the non-resident renders the service unless it is utilized, unless not only that it should be utilized in India, but it should be rendered in India. So therefore, what happened was there was an amendment to Section 917. So in 2007 and in 10. So the first amendment which came was that irrespective of the fact whether the non-resident has a place of business or business connection in India, it would become taxable. So the Karnataka High Court in Jindal Thermal interpreted that merely because of that first amendment, it did not bring within the scope of taxation that income which has escaped because of Ishika Javima. As we all know, that the Supreme Court is the highest court of the land. His judgment is final, and under Article 141 of the Constitution, it is the law of the land, because the Supreme Court does not interpret law, it actually discovers law from the inception of what the law was. So this is critical. So courts they don't interpret law, they discover the principles of law as it was right from the point when it was legislated. That's the duty of the High Court and the Supreme Court. So then in 2010 they amended to say, irrespective of the fact, even if the non-resident has rendered services in India or not. So now the scope has increased. But with the scope increase, the question is that is there still territorial nexus established for the purposes of taxation of these fees for technical services? It's a huge legal question which only courts will answer. Because you have to understand that India is a constitutional democracy. It's a nation, and therefore it can make laws which are extraterritorial in nature as per GVK judgment of the Supreme Court, provided that there is sufficient nexus in India, sufficient benefit to India. Otherwise, extraterritorial jurisdiction is not given under our Constitution under Article 245. So there is a restriction to what extent even the Parliament can legislate laws which are extraterritorial in nature. So let's consider this particular situation. You go to London and you get an X-ray done, and you make payment for that X-ray. It is fees for technical services. So when you make payment to the hospital, you will tell the hospital that I am going to deduct 25% tax or 15% tax under the treaty, or 25% tax under section 115A. How hopeless it sounds, but that's the law. You go abroad, you get architect's plans done, or you pick up some architect's plans and you tell the architect that I am going to deduct tax at source. It's like someone coming from Tanzania to India telling you that you please give an opinion, and then he says, Mr. X, you've given an opinion but it is chargeable in my country, so I am going to deduct 10% and give to you. So I mean, is that law? Is that what the Constitution tells us? I don't know. I am just trying to give you some understanding. I am giving you a twist to the law. So because if you don't think, then I cannot think. So we all have to think. Is that law? Is this amendment valid? I mean, all this will only come out when actually jurisprudence will take place. So now let's try and understand what does section 9 tell us. In short, section 911 tells us that if there is a business connection, directly or indirectly, or the property or asset or source in India, or transfer of a capital asset is situated in India, then it becomes taxable in India. And as far as taxable gains is concerned, even if directly or indirectly, the shares which are, or the right to a particular organization or a company derives substantially indirect or directly or indirectly value from assets in India, then it will get covered under 911. Then under interest income, if it is sourced in India, royalties and fees for technical services if they are sourced in India. Remember, this is the charge as per the Income Tax Act. As per section 4 read with section 5 read with section 6 read with section 9. This is the charge of the tax. Now we will come to the other part. That what happens and why do treaties evolve? So therefore, when non-residents come to India, or whenever there is global trade, across cross-border trade, cross-border transactions, there is always scope for double taxation. What do you mean by double taxation? There is two types of double taxation. So we have to also try and understand the philosophy, why treaties emanated in international affairs. And tax treaties is only one segment of treaties. There are hundreds of other treaties which emanate every day for commerce, for security, for cooperation when two sovereign countries enter into treaties. It's for the purposes of trying to effect trade, effect security, or some other purpose. So therefore, it is nothing else but international cooperation. So therefore, when China says that certain islands in East China Sea belong to it, you have to take their permission if planes fly, then probably Vietnam, Japan, US will get together and say, we don't believe in it, so it sends a B-2 bomber over their island. So I mean, this is international affairs. So treaties is nothing else but part of international affairs, out of which tax treaty is one segment of international law. So therefore, why did they emanate? So let's try and understand that philosophy. Let's say you go and do business in UK, you go and do business in Singapore, or you go and do business in the US. You earn income there, so you pay tax there. Then you come back to India, but because of that one or two stray transactions, because you are a resident of India and your global income is taxable, so now there is a question, I have earned income abroad, but I have paid tax abroad, and therefore that same income is getting taxed in India, so there is double taxation. So why did treaties evolve? Treaties evolved because treaties became, or why did double taxation avoidance agreements evolve? They evolved because they wanted to further economic trade. And initially, the force was only between developed nations. So therefore you had OECD. So OECD, remember, always looks after the interest of capital exporting nations and technological exporting nations. They never look after source country taxation. Now they may have broadened a bit because they get hit, because now it is not G7, it is G20. It is not US, it is US and China. So therefore there is a recognition of economic development of what are known as the less developing countries. Has India developed? Yes. But unfortunately with or without the help of the parliament. So if you have a better parliament, probably there will be better evolution. So therefore there was economic double taxation. So there is double taxation. Now there are two types of double taxation. You went there and you earned income, and you came and paid tax in India on that income and also the other income which you earned in India. So that means you are the same person who's paying tax at both places, correct? So that is known as juridical double taxation. Means the same person pays tax in two countries. Now let's go one step further. You found that US is giving you a good market, so you set up a subsidiary in the US and it started doing trading. So you exported goods to US and US company sold the goods. So when you exported the goods, you had to file Form 3 CB. So you went to the transfer pricing officer. So transfer pricing officer believes that as long as there is an international transaction, the first step is to make an adjustment. That is their purpose. There is no other purpose except for section 92. Is that if there is an international transaction, there has to be an adjustment. In 7 out of 10 cases. They will give you statistics that we only do adjustment for 6 cases. But in those 6 cases, everyone gets mostly covered. So therefore, they made an adjustment. So they are saying, wait one moment, Mr. X, you exported goods at rupees 100 a kilo. We believe the arm's length price is 200 rupees a kilo. So they increase your income in India. And over there, in US, the company purchases only at 100 rupees. It went and sold at 150. So it made a profit, so it paid tax on 50. Here you sold at 100, now it is made 200. So therefore actually there is a loss global. If you see the transaction end to end, it should have been exported at 200, sold at 150, so there should be a 50 rupee loss sitting in US. Instead of that you paid tax there. So therefore when the same economic event is taxed in two separate entities, it is known as economic double taxation. So therefore that is transfer pricing, that is Article 9. So therefore in these cases what countries found was, in the initial years when there was taxation on both sides, that there is double taxation, both economic and juridical. So permanent establishment taxation is one example of juridical double taxation. So to avoid this double taxation, there was an evolution of treaties. If you understand the philosophy behind the section, behind the treaty, you then can tend to grasp better the first principles of taxation. So the Double Taxation Avoidance Agreement was born. It was born in 1927 in the League of Nations, and then it emanated into the OECD and then into the UN. I think the first draft of the OECD was 1963, if I am not wrong, or maybe earlier also. And then it evolved, and therefore now you have the 2010 model commentary which is available, and like that you have also the UN model commentary. So therefore this is the birth of double taxation avoidance agreements. So what is a double taxation avoidance agreement? It is an agreement between two sovereign nations concerning furthering of international trade by trying to see that it regulates tax matters in a manner which is efficient and equitable to both countries. So therefore, double taxation avoidance agreements actually tend to share the right of the country of residence and the country of source to tax that particular income. So there is a sharing of rights, there is a methodology to eliminate double taxation by credit or exemption of taxation, by the credit method or by the exemption method. That's the philosophy of taxation, to remove non-discrimination, to have mutual agreement process, MAP process, so that if there is a dispute, the competent authority of the two nations can get together to solve that dispute, which is also now legislated in our own Income Tax Act by the various rules which have been framed for competent authority procedure known as the mutual agreement procedure. And this is the way double taxation avoidance agreements have evolved over a period of time. So what has been granted by section 90 is that the Parliament says that under section 90 the government has got delegated legislation to enter into double taxation avoidance agreements with any country or any specified territory or specified associations of specified territories by notifying in the official gazette. So this is how you try and understand double taxation avoidance agreements. So what does a DTAA do? There is a charge to tax of a non-resident under section 4 read with 5, 6 and 9. So there is a liability under the Indian Income Tax Act. So therefore residents of particular countries where treaties have been entered into tend to restrict the charge. So what does a DTAA do? Or what does a treaty do? It restricts the charge of the domestic law. That is its first and only purpose. So what is the first principle that emanates from this is that a DTAA cannot charge to tax any income. It can only give relief. It can be better off, it may be worse off, in the sense that particular incomes may be charged to tax at higher rates under the treaty, possible, because the domestic law keeps on evolving, but treaties are static once they are signed, unless you sign a protocol to amend them, or you renegotiate a treaty as is being done with Mauritius. So therefore a treaty will only give you benefit and you can take that benefit, but the income tax administrative authority cannot use the treaty to charge to tax any income which has escaped taxation under the Income Tax Act. That's the first principle and the most critical principle, that the treaty tends to expand the benefit. It restricts the scope of taxation of the domestic law. So what does section 90 say? Section 92 says that if you have entered into a treaty with a country which has been notified for promoting mutual economic relations, trade and investment as the case may be, and the provisions of the domestic law also apply, then the assessee is given the choice to either apply the domestic law or the treaty, whichever is more beneficial to it. So therefore, for example, if you believe that the domestic law gives you more relief, then you may not use the treaty. If the treaty gives relief to you, then you can always use it. No one can restrict that, and that is also given by circular number 333. So therefore section 90 regulates a case where India has a tax treaty and you get the benefit of using the treaty. Though sometimes domestic law provisions can be at times more beneficial. So for example, until the recent amendment in section 115A, the rates of taxation of royalty and fees for technical services was 10% plus surcharge, but certain treaties had 20% also. So therefore there could be cases where the domestic law could be more beneficial. In cases where there are no treaties, there are non-treaty countries and residents of those countries do business with India, then you get relief for double taxation on the basis of section 91. And you will get to the extent of credit for taxes to the extent that you pay taxes on such income in India, so lower off the Indian rate or the foreign country, whichever is more beneficial, not beneficial, whichever is lower. So to that extent credit will be given under section 91. So what is the methodology of giving credit? So one of the main purposes of the treaty is to encourage international trade by avoiding double taxation. And how do you avoid double taxation? You avoid double taxation either by the exemption method, that means you exempt. Certain countries are territorially based taxation like Singapore, and they will exempt foreign income, or you give full credit without any restriction, that means irrespective of the rate of tax in the source in the country of residence, or you will give ordinary credit, that is quasi income that is taxed in India, that is in the country of residence. Certain times treaties may give you underlying tax credit, that means to the extent that dividend income is taxable, it emanates from corporate tax, and if corporate tax has been paid, then to the extent of the dividend income that is received, the corporate tax percentage is given as a relief for the purposes known as underlying tax credit. And in the earlier days, when India was developing, let's take a particular example, that a US resident opens a SEZ in India, for example. When he opened an SEZ in India, and as a branch, not as a subsidiary, let's say, and it earned income in India which was exempt from taxation. That exemption which is given would be of no availment if US were to tax that income, and therefore India wanted to attract investment. So therefore in the initial years, some countries like Japan and Canada used to give tax-sparing credit. So tax-sparing credit means to the extent that India spares the tax, they will also spare the tax in the home country. Otherwise, the exemption which is given in India gets lost, because actually then that gets taxed in the country of residence. So there was tax sparing given. That's the philosophy of tax sparing, which is not prevalent in all treaties, but in certain treaties it is there. So that means, for example, if certain exemptions were given or tax holiday provisions were there under section 80IA or section 80I, in the earlier days 80J, section 10, then to that extent the income which is, the tax which is paid by India was also given relief by the home country, that is the foreign country. So actually it was in the nature of aid, trade aid. that I will also spare taxes if you spare taxes. I will encourage my residents to come and invest in India. That was the philosophy. So we have understood the rationale for cross-border taxation, to encourage trade, to avoid double taxation, and most important, to regulate the rights of each country, how they will tax incomes which emanate over there, right from source country as well as the country of residence. And usually the country of residence would provide unilateral relief, and mitigation can result in relief from double taxation, but not refund by the country of residence. So that means, for example, if you pay tax in US but your business is in loss, you can't expect India to refund the taxes which you paid in the US, because the Indian treasury has not been enriched. So this was the rationale for treaties to emanate, rationale for restricting the charge under the Domestic Act. Remember, friends, the treaty comes into play only if there is an income that is chargeable to tax under the normal provisions of our Indian Income Tax Act. Then only you go to the treaty to find out if relief is available. So what are the basic tenets of a double taxation avoidance agreement? Eliminate double taxation, certainty of tax treatment. All businessmen want certainty of tax treatment, reduction of tax rates, so therefore royalty, fees for technical services. Now, for example, treaties allow you to withhold tax only at 10%, and the scope of taxation may be reduced also, lower compliance cost, then prevention of fiscal information. So therefore nowadays many countries are signing what are known as tax information agreements, so that there is no fiscal evasion. Prevention of tax discrimination. So that means when residents come to do business in the source country, then they should not be discriminated by the source country as they should be treated at the same level as other enterprises would be treated by the source country in the taxation. Resolution of tax disputes, provision for tax sparing, and exchange of information, which is most critical nowadays because of these huge tax haven problems and black money problems and other issues which are there prevalent throughout the globe. So when it starts hurting the developed nations, they get up. Till it did not hurt them, US did not bother, nor did UK bother, nor did Germany bother. But once it started bothering them, they started going after the tax havens. Till that time, they did not bother. So that's the dichotomy or the hypocrisy of prevalent in the world today. So let's try and understand the basic structure of a treaty. Just like section 4 is there, which brings something to charge, and section 2 defines what persons are covered. So article 1 and 2 is the persons covered, taxes covered. Article 3 is definitions governing the DTAA. Just like section 2 of our Income Tax Act, rules of residence, defines the meaning of the term permanent establishment, provides for the distributive rules regarding income taxes. That means article 6 to 21 deals with various incomes, right from shipping income, income from immovable property, business income, dividend, interest, royalty, fees for technical services, dependent personal services, independent personal services, artist income, consular income, all types, capital gains and other income. So all these incomes, that is, they are known as the distributive principles of the treaty, just like we have heads of income. So they have known as the various incomes which are covered. So we also have various incomes which are covered under various heads under section 14. Then what is the taxes on capital gains, elimination of double taxation, special provisions, and then final provisions. This is the structure of a double taxation avoidance agreement, basic structure. Recently, the CBDT has notified Cyprus as a notified jurisdictional area under section 94A as an anti-avoidance measure. So in section 94A says that if there are certain countries which do not share information which is critical, then to that extent that country will be notified under section 94A, and the impact will be that transfer pricing would be applicable for all transactions with residents of those countries, as if they are transactions between two associated enterprises. Withholding of tax will be done at a punishing rate of 30%, and no deduction of payment will be given for expenditure incurred by Indian residents when they make payments to entities in Cyprus. So therefore you discourage investment or doing business with Cyprus. So therefore there is news item that Cyprus is trying to correct that situation. So this is nothing else but like waving a red flag. If you don't do this, I will punish you. This is what India is trying to tell countries. So therefore, because it is better in the negotiating power, that's why it can do that. Maybe 20 years ago it could not have done that. So now Cyprus has notified, and there are talks which are going on between the two competent authorities to correct the situation. So therefore this is an anti-avoidance measure which is there under section 94A of the Indian Income Tax Act. Now we come to a very important part when you deal with remittance, is the provision of section 163. You see, what happens is that non-residents have very transient presence in the source country, or in India for example, because we are dealing with remittance from India to foreigners or to non-residents. Because of their transient presence in India, the income tax authorities may not be in a position to catch them. So how do you protect the tax base of the rightful taxes that are due to be collected? And therefore you have section 163 on the statute, which says that even if the non-resident cannot be traced, if there is a nexus with a person in India as an agent, then in a representative capacity, that agent will be liable for the taxation of the non-resident. So therefore, a person from whom the non-resident receives income directly or indirectly can become taxable in the representative capacity under section 163. What is representative capacity is given by section 160 and 161. So 163 brings into play the vicarious liability. The vicarious liability that can fall on a resident if it has some business nexus with a non-resident, and the non-resident has not paid the rightful tax that is due. So it's a vicarious liability. It's a liability which comes from thin air, and therefore when you deal with a non-resident, you have to be extremely careful and vigilant so that no vicarious liability should fall on you under the Indian Income Tax Act. Even a non-resident can be treated as an agent. Simultaneous proceedings against the non-resident agent are barred, but they are not barred for different sources of income. But for the same source, they are barred. An agent is not liable to deduct tax because you are charging him to tax as if he is in representative capacity itself. That means he is chargeable to tax. So therefore, section 163 is critical when you deal with remittances, because it creates a situation whereby vicarious liability falls on an Indian resident because he has got some dealing with the non-resident, and the non-resident's income has escaped assessment. So therefore, it's a vicarious liability. Now we come to withholding of tax, where this whole conference has been structured. But to understand withholding, you have to understand the charge of tax, the play of treaty, and the vicarious liability under section 163, friends. So the withholding tax obligation is under section 195 subsection 1. Any person responsible for making payment to a non-resident shall withhold tax. But important word is only in respect of interest or other sum chargeable to tax. So the most important word is sum chargeable to tax. At the time of credit or payment, whichever is earlier, at the rates in force. Therefore 195 does not apply to salaries and exempt dividends under section 115(o). So the objective of section 195 is that instead of the income tax department going behind non-residents to catch them, which is elusive because they are stationed abroad, every payment which is made by a resident will be inspected and analyzed whether you should withhold tax, so that once tax is withheld, whether the non-resident is now traceable or not, the Indian Exchequer has got its pound of flesh. Or, to be put correctly, the correct income that was chargeable to tax has been charged in the hands of the non-resident by way of an intermittent process known as withholding of tax. So when you withhold tax, you are actually acting as an agent of the government. So actually speaking, considering nowadays the problems of online filing and other things, the government should be paying an administrative charge to us because we are withholding taxes on their behalf and paying it to the Exchequer. They should be defraying our expenses. I think some politicians need to put it up before the parliament that when individuals, even today individuals are caught within the net of TDS, correct or not, if you are under tax audit, and therefore individuals, forget companies, if they are doing some service to the government, it is better that they are also defrayed their expenses. So probably some X percentage of the taxes collected by them should be an incentive for us to do our work correctly, professionally and in time, instead of them charging us interest if we forget to pay late by 1 day. But that is not going to happen.
That should be done even locally.
Yes. So therefore, any withholding done under the withholding chapter should be done. So any person, therefore now we come to the most important person is that when they write any person, does it cover non-residents? So friends, the better view is that non-residents should not be covered. A and B in England do business together. Someone sells them, for example, some architect drawings. For him to put up a factory in India, he is saying that now because you made payment to B, please withhold taxes. So that person B in UK will hold his head and smash it against the wall and say, what type of taxation is this? Better you bear the taxes, gross it up and give me my money, he will say. So therefore, this is the process. But law the better view is that it should not be applicable. But there has been an amendment to Explanation 2 by Finance Act 2012 to Section 195, which says a non-resident is covered whether or not he has a residence or place of business or business connection in India or any other presence in any manner whatsoever in India. Whether he has or not, a non-resident is covered. But does it mean that what is legislated is correct? I don't know. I think jurisprudence will evolve over here. That can non-residents be covered? Case law is slightly against us because you have Asiasat and you have Bechtel, which says that even non-residents are supposed to deduct tax at source when they make payment to other non-residents. But the better view should be no. You may have some reverse charge mechanism as they have in service tax to a non-resident who makes payment to a non-resident, that he should deposit tax on his behalf. The rates of deduction are those which are given by Section 2. What does Section 2 subsection 37A state? It states that the rates in force are those which are given by the Finance Act or in the DTA, whichever is more beneficial. So does the Circular 728 say, and therefore they are the rates either in Section 115A, which are there, or by the Finance Act or by the DTAA, whichever is more beneficial. Issue is that when you look at treaty, does it include surcharge? The better view is that the treaty rates are final and inclusive of surcharge and everything, and additional surcharge also, that is cess. Now we come to the most important part, and this is where professionals come into play, that if remittance is to be made and you have not gone to the income tax officer to get a certificate, which we will see under Section 195(2), 3 or 197, then a chartered accountant certificate is required in the new form 15 CB. Read with Rule 37BB, and all the information is to be now furnished electronically, and there is an amendment made to the new forms which will be taken up in the seminar. But the important thing is that now CAs, remember that when you issue this certificate, you are issuing certificate as if you are a quasi-assessing officer. So therefore you have to be circumspect, clear in your mind regarding the taxation of that payment before you issue that certificate. Though I am aware that sometimes these certificates are issued as a matter of course, but now there may be a possibility that the department, as they wake up to various things, is there any vicarious liability on you, is something that has to be inspected. As long as you have taken due care and there is no negligence, then there is no issue. But that due care has to be taken when you issue these certificates, because you as a professional are now acting on behalf of the government, sitting in the shoes like an assessing officer and coming to a conclusion whether that particular payment that is being made tax has to be withheld or not to be withheld. Nothing to be afraid of, but something not to be taken lightly, that's all. And I think this important aspect will have to be looked into when you issue the certificates. So, the payee can also apply under section 197 to obtain a certificate at a lower rate of tax or a nil rate of tax. And the assessing officer, being satisfied that the total income of the recipient justifies such deduction at lower rate, he will issue such certificate. So let's see what are the methodologies which are available under the Act for both the payer and the payee to approach the tax department to get nil withholding tax certificate or withholding certificate at a lower rate. So under section 195(2), the payer can approach the income tax officer that the whole of such amount is not chargeable to tax. In case of 195(3), the payee approaches, while in 197 the payee approaches not only for nil withholding but even for lower withholding. An order under section 195(2) is appealable provided the payer is liable to bear the taxes and he has borne the taxes and paid the taxes. There is no appeal available under section 195(3) or 197. So what has been the progress of jurisprudence as regards section 195? I think Transmission Corporation was not correctly interpreted by the department, where it believed that whenever there was a withholding to be done, you have to approach the tax officer. Actually, what Transmission Corporation said is that if there was income chargeable to tax and you have to determine some complex reason, then you may have to approach the assessing officer. So at least that first part, that income chargeable to tax, that is sum chargeable to tax, that means income that sum has to correspond to income which is chargeable to tax under the Indian Income Tax Act, read with the treaty. But Samsung was against us, but the Supreme Court in GE India Technology clarified that if there is no tax, then there is no obligation. If there is tax, there is obligation, and therefore now you can approach under 195(2), 3 or 197, or you can approach the CA. And you have to remember there is a double whammy. If you don't deduct tax properly, irrespective of whether the CA issues the certificate to you or not, there is a disallowance that stands, a sword is hanging on your head under section 40A, Roman small 1. So therefore that also you have to be careful. Now you have this section 206AA, which says that if the deductive fails to furnish the PAN, then you will have to deduct either at 20% or the rates in force or the rates provided in the relevant provision of the Act, whichever is higher, and this is applicable from 1st April 2010. And therefore it will be applicable to payments made to both residents and non-residents. And no AO can issue a certificate at a lower withholding unless PAN is quoted. Only thing is that law will evolve that will 206AA prevail or whether the treaty rate will prevail. That is something which the law will evolve. There is only one case which I would like you to refer to in this particular aspect as far as 206AA is concerned. 346 ITR 156. Kaushalya Bai, which says that, but there are typical facts, that banks and FIs cannot ask for PAN from people whose income is below taxable limit. But that case is on typical facts, so it doesn't become general law. But I'm just trying to say, have a look at that case. It will give you some food for thought. As Paresh says, I don't like to serve googlies, but I like to serve some brain teasers for breakfast in the morning, before tea, no? Achha. Now the last part. There is a process whereby when you deal with non-residents or the non-resident himself can approach the authority for advance ruling to determine the taxability of a particular business transaction. Who can apply a non-resident or a resident undertaking a transaction with a non-resident so that he understands his liability of withholding taxes. Who shall be members? A retired judge of the Supreme Court and an IRS officer qualified to be a member of the CBDT and an officer of the Indian Legal Service. Fees is 10,000. Important thing is that it gives you a proactive basis to determine your tax liability. It's binding only on the applicant and on the commissioner, the income tax authorities and subordinate to him, and time limit is disposal by 6 months. And friends, I hope you had a good morning breakfast with me. Thanks a lot.
Friends, you all agree with me that Vispi has performed task of an opening batsman, and something is well set and well toned. There is always match is half won. So therefore, with this first technical session, we will not have much time for question answer. So we will take up those questions a little later in the subsequent sessions, and we will break for tea after vote of thanks. May I request Rajesh to propose a well-deserved vote of thanks for Vispi.
Yatin Desai, Mr. Paresh Shah, and friends. We are thankful to Mr. Vispi Patel for agreeing to be an opening batsman and give a talk on overview of taxation of non-resident on the morning of Friday the 13th, and request all of you to carry it with loud applause. We'll break for 10 minutes for tea and then we will quickly reassemble. इंट्रोडक्शन करूँ